Hello everyone, and thanks for joining the course. Let me know if you have any sound or video issues. Let me check the stream quality real quick. So if you have any video issues, you can change the quality to 720p. In that mode, it should be okay. It should be good enough to look into. And the text must be readable. Okay, thank you. So let's move into homework. Homework number 2. To be able to do that homework, you will have to do homework 0 and homework 1 and have your file established, homework file established. You can copy that copy me file and work in that file. I see that not much work was done since October 30. Let's see now what we have for the homework 2. So the task for the homework 2, the first one is optional and it's pretty short. So you need to create a copy of that accounting resume file and try to apply several recommendations from the lecture and from the Harvard Business Review article and implement in your resume some requirements from the list of accounting positions. Let's see, homework 2. Okay, here's the list of requirements. So I copied the list of requirements for accounting positions. And our task is to come up with a creative way to mention that we actually have that experience without actually doing that kind of a job. And to do so, we will practice that kind of experience in the course or in some other conditions. So let's see, someone is watching. I'm getting error message. I'm not sure, let me know if something comes up with the quality. So okay, so what we do here is we take some of these experiences and just try to rephrase it like we call that subheader as a relevant experience, not work experience but relevant experience. And we say that we kind of run accounting and bookkeeping for small business as a part of practical course, or you can call it a bit differently. And we can just describe our course experience from the point of view of these requirements. It's actually covered in the previous Q&A session and in the lectures, and it's actually optional. You might not need to create a full scale resume right now, and you might want to go back to that task in the future when you actually need to do a resume. So I'm done with that part. If you have any questions, just post and I might return to that task. So all the requirements are here. And let's move on to the Quickbooks part. So I think that many of you expected Quickbooks. So we log in, sign in, Quickbooks Online Accountant. So we sign into QuickBooks Online Accountant and we go into homework file. So what do we do in QuickBooks? We post owner's investment. Okay, so that's new bank deposit. I won't do that right now because we've already done that. So I click into owner's deposit and I select a date, I select an account. Let's see what we have here. Fixed assets, expense, equity. So we have equity accounts here and we call it just owner's investment. I won't do that, I've done that in the previous parts. Yeah, I just close it. Let's see what else do we have here. Post-building acquisition with cash and mortgage via journal entry. New journal entry. So we click plus, we do journal entry, and we select the date, and we select the account number. So the first one, it's better to start typing probably. So first one is cash. We paid cash. We paid 50,000. That numbers I'm taking these numbers from our transaction list in our homework file. So these are here. You can use your own numbers. That's not a big deal. What else do we have? So we book everything. So we bought a building. So we need to debit building. Let's see if we have it here. Yeah, if you don't have, you just add a new account. Let's see if they offer you such option. Yeah, you can just enter building 2 and create such account. So it's account type fixed assets, building 2, detail type buildings. Okay, save and close. So yeah, let's move the amounts to that account, 200,000, and we are left with the mortgage. I've already created mortgage account, so I will enter it here, and I will do that based on my transaction list. So I also need to add a current mortgage account. Current mortgage account, 2,000. So as you can see, QuickBooks tries to balance all your entries here. Let me know if video quality is lacking something. For me, it looks like it should be working, but your mileage can vary. Okay, so we did that part, and we save and go to the next entry. That might not be the cash entry, the next one. Let's see what we have in the homework. Post inventory acquisition into account. Inventory acquisition on account. That means that we use a trade payable account. But first we need to establish an inventory item in QuickBooks. How do we do that? How do we establish an inventory item? The homework contains an instruction. So first we go sales, products and services, enable inventory. Let's see. Sales is here, products and services. Inventory. Let's see. Let's click new. I will add that to the instruction. I will add that into instruction. A new button on the right. And then we enable inventory here. And we call it merchandise 3. I call it merchandise 3 because I've already created 3 different inventory accounts. Let's see what we have here. We have category. I don't pick up anything, so that will only complicate our transactions thus far. When you will have actual business, you might want to find out how all of that works. So let's see. Initial quantity on hand 0. Inventory assets account. Inventory merchandise. Description sales price. Yeah, I just keep all of that. Something is not right. That's interesting. Let's just say, okay, September 30. No? Okay, let's see. Yeah, it works. So problem was with the date. As you can see here, that report also provides you with a summary of quantity of inventories. That's because I've already done that transaction several times. That's why I have something here in the report. So what do we do next? We enabled inventory. Now we added inventory. So on the enabling, let me just, I believe you will have enable button earlier. When you just started, you will have the enable button, and then you need to add the inventory. And now we are going to purchase some inventory through the bill. That operation assumes that we are creating a bill. We are getting a bill, an invoice from a customer. Let's click bill. Let's see what we have here. We create an imaginary vendor. We create a vendor, and we create a quantity and price of inventory purchased. Okay, let's see. I already have one vendor, but I will add another. Merch vendor. Let's call him merch vendor 2. Save. So basically, when you start working in your own QuickBooks, you will be filling it out with all your new vendors, all your new customers, all your new inventories, and you will build it over time. So let's see what we have here. For that purchase, you will need to use item details. So we already have all that merchandise here. So let's say we bought merchandise 3, and let's say we bought 500 items, and we paid $5 per item. So that ended up 2,500. And let's just save it. What options do we have here? Save and close, save and new. We do not want to schedule a payment so far. We just save. And let's see how our transactions reflected in our QuickBooks. Let's go to report, reports. And in the reports, let's find, let me check for a moment. If you have any trouble with YouTube chat or with questions, you can ask questions in the Messenger or in the Telegram. I have those open. to monitor activity. Okay, let's see. So we go to balance sheet report. And what do we see? We see cash on hand. And if we click here, we will see that October 21. Let's see. Let's start with January 1st. Run report. Okay, will I be able to run it from September? Okay, so I ran balance transaction report from September through October, and I run that report based on cash. And if you see the transaction captions kind of repeat one another, because I showed you one and the same example several times. So we deposited 100K once, twice, so we put it into owner's investment. So 3 times. We put 3 owner's investments here. That's in my account. In your account, you will have different situation. Then we acquired a building. I put a description here. It's a good practice to put a description of what's going on. Next one. So building 20,000. What was that 20,000 about? Let's see. So that was a purchase of inventory through cash, through a journal entry, not through bill pay, but through a journal entry. A bill pay is a situation when you receive a bill and you want to kind of book it or maybe pay it immediately. And in that case, you 1, 2, 3. Okay. Okay, 1, 2, 3, 4. Now there should be sound. There is a bit of a lag. There was a bit of a lag in the translation, so I will repeat my problem here. So if we run inventory report on an accrual basis, and if we run it on the cash basis, we get different amounts. And if you already done lecture 2, module 2, that's this Saturday, you probably know what the reason is. And the reason is that we only paid for 30,000 in inventory. So let's go back to balance sheet. And let's go into accounts payable. And we have 1200 here. Let's start with September run report. And you might see that we only paid so this was bill payment. We only paid 15,000 in our accounts payable. But let's see. So inventory 10, 10, 5. That's interesting. I need to look into that. I would expect that the difference is due to accounts payable. But so we have 12,500 in accounts payable. And we have inventory accrual basis. And we have 47,500 inventories under accrual basis. And what do we have with a cash basis? 30,000. So the date is correct. So we account for journal entry here and for 10,000 paid inventories. That's interesting. So the difference is definitely due to some inventory being paid for and some inventory not being paid for. But I currently can't grasp the reason for the difference. It looks like it doesn't take into consideration the inventory acquired in October for some reason. Or probably it just takes into account inventory acquired for cash, even if we paid the bill. So let's see, we acquired 47. Here, accrual, cash basis 30, so difference is 17,500. And if I go back here into accounts payable and run the same report for September and October. So we acquired 27,500. and paid 10,000 and paid 10,000. Okay, that's interesting. I cannot reconcile that from the first try. Let's see what happens if we just pay some bills. Let's go. Let's go here, pay bills. We have two bills here. And you might see that both of them are kind of overdue. So we just take 5,000. Oh, sorry, it's for 2,500. 2,500. And we see how it will impact our cash. And we just save and close. So here is a button, schedule payments online. We do not have bank account connected to our Quickbooks. So we just save and close. That way the bill is paid. This one is also paid. Okay, so let's go back to inventory. Reports. Inventory. Here in assets. So the amount based on accrual method doesn't change. But what if we pick up cash? It's still 30,000. So probably the conclusion is when we bought inventory for cash, it will reflect in your cash financials. If we acquire this true, let me do one more experiment because it doesn't look intuitive. Okay, I will probably need to dig deeper into that because in my mind that doesn't reconcile properly. So let's see what we have here. Yeah, we paid that bill. We paid that bill. Let's see how it reflects in our cash. Let's try cash flow function for that. Cash flow. That's some kind of analytics. I don't think we need it currently. Okay, Quickbooks cash. Okay, that allows us to connect Quickbooks. Connect different online accounts, view paid invoices, expected money out, overdue bills, view reports, expenses by vendor summary report. And we want that from September through November. Okay, for some reason it doesn't show as a report. Expense. Okay, it shows us numbers based on the cash basis. That, I would assume, is because for other inventory purchases, I probably haven't added a vendor. Accrual. For accrual, it's empty. So that part of the Quickbooks supposes to show you your cash transactions, but for some reason, it doesn't show you all your data. So total only Oh, okay, select periods, cash accrual. The alternative way to move at that is to go through reports, balance sheet, and cash on hand. In the cash account, you will see your movements in the cash. So what did we pay today? We paid 2,500, and we did that in November. Yeah, so probably that was the situation I was seeing. So we paid in November. And here it is. And we get 100K deposit for investment, and we paid 50K in September for the building. Let's see if we can change that to September. In that situation, we are able to change it. Let's assume we paid all our bills in September. Here I'm just experimenting with Quickbooks, and I see how any of my manipulation has an impact on accrual and cash basis. And a bit later we will, okay, September, save and close. Accrual, cash. So cash account is the same on both accrual and cash basis. Okay, let's see. So here are the additions to our inventory. Let's look on the difference on the cash schedule. So we have inventory entered through journal entry, and we have only September 30th bill in our inventory. Okay, so let's see what that transaction was. 10,000. Inventory, merchandise, description. Yeah, so it ran, that transaction ran through category details. So here is the problem we had. It didn't run through product details, it ran through category details. And that's why cash amount is different from what we have in accrual basis. So that's interesting to know. I will need to dig deeper into that. Okay, so we are done with this part. Let's take a quick look on the income statement, and then we will concentrate on accounting memo and accrual basis of accounting. So for income statement, we do a search, financial statement preparation guide by PwC, and we go here and we select full guide. That's for those who didn't save it. And I will just send my link to here. Okay. So well, last lesson we finished with balance sheet and we got to page 21. This is an income statement. And here we have the structure for income statement. All the basic income statement headers which we can use in our homework. And in our homework file, we created a separate tab and we provided the headers. And we mapped trial balance, income and expense accounts to the headers in the income statement. And we used SUMIF function to SUMIF from the trial balance accounts. That's basically the same task which you have, similar task which you have with the balance sheet, but you do that with the income statement accounts, the ones which represents your revenues and expenses. Okay. Hopefully you will not have a trouble with an income statement. I do see Maria working in her file today. I will just take a quick peek here. Okay, she have trial balance here. In her trial balance there is no, is it trial balance or balance sheet? Transaction list. Expense revenue. So Maria has some revenues and expense accounts here. Let's see if she has that. Yeah, she has that on the trial balance, but she hasn't created an income statement tab yet. So I will help her a bit. But that's it. It's her homework. So I don't think anyone did an income statement so far. If you want to have a review, you will have a chance tomorrow on Russian Q&A. If you do your homework by tomorrow, we can have that. Okay. So here is a file of Irene. You cannot have balance sheet and income statement in the same column. You have to have income statement mapping separately. And you need to, oops, sorry. You need to enter it here. Let's see what you have here. Revenue products, revenue services. I don't know what your business is, whether you separated products or services. So you need to have something like that. And in here, you need to refer to FF, so we go look into trial balance, AA, and we see revenue products. Okay, but in here, we need to look into EE. That's where your numbers are. I will highlight it by yellow, meaning I messed with that. Okay, where is the trial balance? So I messed with that column. I will highlight it in yellow in full. And I also messed a bit with an income statement. So that should be an easy exercise for those who did the balance sheet. That should be an easy exercise. Hopefully you will be able to do it. Now let's move to an accrual basis. For that part, let's Google a bit. Let's do our own research of accrual basis. Investopedia and accounting tools, and probably that should be enough. What is an accrual accounting? So accrual methods is the method of accounting which is different from the cash method. And cash method might be intuitive because when you pay cash for something in your everyday life, you pay your expenses with the cash. You might want to delay those expenses paying by credit card and then paying credit card. But more or less, it always corresponds with some cash payment. And in that situation, that type of accounting, it exists, and it even allowed for some small businesses. And in that situation, you just record your cash transactions. Let's consider, and that's called a cash basis of accounting. Let's see if they have definition here, or maybe links to cash accounting. Okay, no definitions. Basically, under cash accounting, you recognize your income when you receive cash for your products or services, and you recognize an expense when you pay cash for some cost of sales items like inventories, services, or other products or utilities. So basically, cash in, you recognize some income; cash out, you recognize some expense. That's all you need to know about pure cash basis. What is an accrual accounting? Accrual accounting measures companies' performance and position by recognizing economic events regardless of when cash transactions occur. And its revenues, accrual method records revenues and expenses when the transaction itself occurs. And they also mention a matching principle here, and which says that expenses should match the period when the revenues occurred. So when you get some revenues, you incurred some expenses to generate those revenues, and you need to recognize these revenues and expenses in the same period. Let's see if we have other. So the other, we have that we record revenues when earned and expenses when incurred. And let's do an example. Let's go to our transaction list. Let's see, I have freeze panes here. So in my transaction list, I already segregated accrual basis of accounting and cash basis of accounting. So let's see. Let's see, for example, when we do like a sale transaction, we sold products to someone. Let me recall that. Okay, let's do it that way. Oops. Okay, what do? We sell our services on credit to customer. On credit means that customer didn't pay us. So no cash moved at that point. So we generated receivables. We generated revenue. Sorry, I need to fix that. Okay, so that happened under accrual accounting. And what happens under cash accounting? Nothing happens. Zeros. That's because no cash changed hands. Now, in 2 weeks, customer pays for our services. So in 2 weeks, customer paid for our services. So we kind of repay our accounts receivable. And we get cash. For those of you listening today, let me know if I need to go further on accrual versus cash accounting, or shall we switch to accounting memo related to IRS publications. Just let me know. Let's say if you want me to continue on accrual versus cash basis for accounting, send me 1. If no, you can stay silent and I will switch back. Switch to the next subject. So under cash method, when we received cash, we recognize the income only when we received cash. Let's say we have the following transaction. Let's say we purchased on credit. We purchased inventory on credit. So what do we reflect in that situation? Let me use our traditional inventory account, inventory merchandise. $3,000 minus $3,000, and under accrual accounting, we record inventory. We capitalize inventory. We purchase inventory in credit and okay, in cash basis. In cash basis, we expense that immediately. Okay, let's say just expense. So we basically debit it to expense at the moment we bought it. Now, let's say we sold inventory in the sales transaction above. So in the transaction above, when we sold something to the customer, sell services, let's say we used inventory in the sales transaction above because we sold services, but we used something to render the services. We recognize debit some form of the costs of sales. Where is it? Cost of sales services. Yeah, let's go to trial balance for the account. Cost of merchandise used for services. And we credit our inventory. And we do that for that total amount. Now what happens in the cash basis accounting? So basically nothing happens. We have already recognized that expense here. Okay, I see 1, which means we will continue a bit more on that type. So let's return. Let's ask here. Let's say we have accrual versus cash basis header here. Svetlana, did you make anything in your homework? Do you want me to look into your homework? Sorry, I need to put it right here. So here, let's highlight it. This is revenue earned but cash not paid yet. So that what the definitions mean about accrual basis of accounting. So when we sold our services, we usually, in most of the situations, generated the sale, but we haven't received money yet, but we have to recognize revenue under the accrual basis. In 2 weeks, customers pays for our services. Cash coming in to recognize revenue under cash basis. We purchased inventory on credit. So in that situation, sorry, I did a big mistake here. So we purchase inventory on credit. That changes everything. So that should have been trade payables. Let me use an account from the trial balance. Accounts payable trade. And in that situation, there is no impact on cash basis accounting. So we recognize the trade payable and we expand the inventory, but we still have that trade payable, so we have to pay for inventory purchased. Paid for inventory purchased in 2 months. So in that situation, we use an accounts payable account, which we debit and we use cash account, which we credit. So we paid for that. So 3,000 went for accounts payable with a minus, with a plus, and that came out of cash account. Only here we will recognize an expense. Only here we will recognize an expense. So what we did here, so we purchased inventory on credit. Title to inventory transferred to us. And we recognize. So here we got a title to inventories, and now that inventory is our asset, despite the fact that we still owe money for that inventory. And on the next step, we use the inventory in the sales transaction, in that sales transaction. And that would be matching principle. Let's see if they say anything here about matching. Yeah, they even have a separate definition for the matching principle. Matching principle requires that revenues and any related expenses be recognized together in the same reporting period. I will copy that here, and I will highlight matching principle. Okay. So here is the main difference between between accrual basis and cash basis of accounting. So under the first one, under the accrual basis, we recognize something when transaction happened, when title transferred for the goods, or when you rendered the services, or when you bought the services. And under cash basis, something only happens if cash changes hands. So for example, if you sell something on credit, you recognize sales transaction immediately under accrual basis. But under cash basis, you will recognize it only when you receive cash for that sale. And the similar situation is with purchases. When you bought something, when you bought an inventory, you recognize that inventory as an asset under accrual basis. Under cash basis, you just do not recognize anything. When you expense some inventory, when you used some inventory in your production and sold something, you recognize an expense under accrual basis because you use matching principle to match your revenues. That expense, inventory expense, in that situation, it matches your revenue. And you only recognize expense in the cash basis when you actually expense when you actually pay for that inventory. And respectively, you can see that you kind of never use trade accounts payable account and accounts receivable account for the cash basis. So these are like always zeros under cash basis. And let me also give you one more example here. We say that we recognize the revenue under accrual basis when we earn that revenue. For example, if you sell a product, you recognize the revenue when the product is actually sold, when you kind of transfer the title to that product to your customer. That's in most circumstances. It's just the most simple example. You transfer the title to the customer. Now customer owes you money for that product, and assuming all of that is in the contract, and you recognize the revenue, and you recognize trade account receivable. That's earning the revenue. You incur expense when you reflect the expenses which match that revenue. So if you sold inventory to a customer, you need to reflect an expense for respective inventory sold for the cost of inventory sold. But there is another concept, and it's called periodic expense. It's rent, utility, admin, etc. So there are some expenses which are difficult to allocate. Sometimes you will have to allocate those expenses to inventory. But most of the time you just incur that expenses in the period in which they occur. Let's say we paid utility for current and next month. So what happens when we paid utility? Depending on the situation, if you already accrued that expense, let's break down it into two transactions. Accrued but not paid utility for current month. Debit. Let's see if I have something like that in the trial balance. No, I don't. So let's call it utility expense. Let's say it was 600. Credit. Accounts payable trade. Same 600. Anything happening with the cash basis of accounting? No, nothing happens. Here we accrued the utility bill for this month because assuming this is kind of administrative utility and we do not use that utility to produce or somehow transform our inventories. In that case, we just accrue it, recognize expense on a monthly basis for actual utilities consumed or for our estimate of utilities consumed. And then let's assume we paid 2 months utility bill. So let's start with credit. cash 1200 with a minus since this is a credit. So we paid 2 months, current months, so we need to debit trade accounts payable. We debit trade accounts payable here, and we need to put some prepayment here. So we create a debit. Let me use just some existing account prepaids. And I will give you a bit of a hint here. So what happens with cash basis of accounting when we do that, when we just accrue an expense? So if we say accrue, basically that means that in the cash method of accounting there will be zeros. Now we have a cash impact here. So we definitely have to have something in our cash basis of accounting. And that when we paid cash, we say, okay, that was an expense. So for now, we already passed 1 hour with our lesson. For now, I will finish accrual basis and cash basis, and I will probably produce some form of a memo, additional memo, if additional explanation is required. Let's now move back to our accounting memo. So how do I describe that in the homework? We need to produce a memo regarding treatment of the following transaction for the tax basis, depending on whether you selected cash basis tax treatment or accrual basis tax treatment. And that cash and accrual basis tax treatment is completely different beast, because tax authorities want to make their own rules regarding recognition of revenues and expenses. The closest to the tax rule you can get is probably accrual basis of accounting. So let's say account, let's say, okay, so here is an account, and let's say it's under accrual basis of accounting. So here we will look into accrual basis of accounting, and we will describe the transaction here. Like for example, we have a prepaid expense, prepaid revenue. So someone send us a prepayment. Someone has sent us a prepayment. Debit, cash, credit, prepayments, receipt. Now, depending on what type of taxpayer we are, if we document if we selected the cash basis tax accounting, let's just add here, we will add cash basis accounting. So in that situation, when we received cash for prepaid revenue, we will still debit cash, but we will credit revenue cash basis. I will call it a different kind of revenue because in order not to confuse it with other types of revenues. So these two columns are accounting. These two are taxes. And under taxes, you have, if you are a small business, usually less than 25 million average turnover for 3 years, but some other exceptions as well, you have a choice to use a tax basis based on cash accounting and use accrual basis accounting. And both of these, they are based on IRS publications. So here we have IRS publications. That's where your CPA go when, or your tax agent go when, enrolled tax specialist go when they calculate your tax liability for your business. 535, 538. Let's see what we have here. Prepaid revenue. Under cash method, you include that into your gross income. That's publication 535. Let's see which one is that. 535. No, not business. 538, sorry. Cash method. Income. Under the cash method, you include it in your gross income. All income you actually or constructively receive during the tax year. So we said it here. Here, they actually give us a choice that generally we recognize advance revenue as an income in the year when we received the payment. However, if we use accrual method of accounting, we can elect to postpone including the advance payment in income until the next year. However, you cannot postpone including any payment beyond that tax year. So basically, they give us a year. They give us like additional year. So if we are accrual taxpayer, if we use an accrual method of accounting, we can elect to have our prepayments received treated based on accrual method, not based on cash method. Let's also add some who can benefit. Let's try to find out some practical implication. So which method will defer income? With which method we can defer income tax? Income and income tax payment respectively. So accrual in that situation, because if we received a revenue prepayment, if we received prepaids from our customer, if we usually received prepaids from our customer, we can defer revenue using an accrual method of accounting and using accrual tax accounting. That's because to defer the prepaids, our IRS require us to use accrual basis of accounting. Let's add here accrual tax method might defer income, but accrual method of accounting is required for that. So let's say let's say we have a subscription-based business, small subscription-based business, small sub. Can benefit from so if subscription-based business received majority of its subscriptions like in a year ahead, like an Amazon, but Amazon is a big business, he will oh, sorry, I'm actually not correct here. Subscription-based business. I mean, that's not applicable here because everyone, big business, is required to use accrual method of accounting. And the third question is, which method allows more manipulation with your income? In some circumstances, you want your income to be accelerated, and in some circumstances, you want your income to be deferred. And in our case, we have a bit more manipulation with the accrual method of accounting. So we can recognize the income early and under accrual method, and we also can recognize the income later under accrual method. While in the cash method, we only recognize income in one situation, when we get cash. So in that cash, we have more field for manipulation with accrual method. And it's all legal. It's all legal. And if we are a subscription-based service and we received a lot of money ahead, so customers are making upfront payments, they prepaid subscription for 1 year. And if they prepay subscription on December 31st or in December 1 year, under cash method, you will recognize that revenue in December of that year. And under accrual method, you will recognize that revenue 1 month in December if it's covered, and then the rest of the time will go to the next year. And that way you kind of flatten your earnings and you decrease your tax liability. So that's prepayments. Now let's take a look into cash revenue. And I would assume, so that is, oops. In that case, our methods correspond. We get cash, we credit revenue. And same will be under cash basis. And there will be no differences in the tax accounting for the cash revenue. So we basically just recognize income, the same rules listed here will apply. So the rule which is applied will be different, but because we get cash at the moment we generated revenue, the result will be the same. Let me merge this and say the rules above will apply. However, the result be the let's say the income, taxable income will be recognized and I will just put same everywhere. So in the situation when we generate only cash revenue, some small business generating cash sales, selling its, I don't know, services, plumbers, electricians, dentists maybe, under both cash taxation and accrual taxation, the result will be totally the same. Now let's consider a situation when we are paid for the revenue after we completed a sale. So like some time passes between we generate revenue and when we get cash. So first one, we will debit accounts receivable, credit revenue, and then after some time we debit cash and we credit accounts. So that's under accrual. Under tax, after revenue, nothing happens. After some time, debit cash, credit revenue, cash basis. So let's see what our revenue guys have to say about that. Let's go here, income. So under cash basis, under cash method, it's a situation that we recognize income we actually are constructively received during the tax year. We have it here. It's the same wording as here. Let's say we have next tax year here. And same here, next tax year. And let's say here. So under cash method, we will recognize tax income when we get cash. Here, let's go to the guidance. Please submit your questions. I'm finishing up with that example. I will continue working on that memo during the Russian Q&A. But currently I'm finishing up with that part of the memo. Hopefully you get a bit of more understanding for accrual versus cash basis and accrual method of taxation and cash basis of taxation. Remember, you need to remember these are four different methods. It sounds a bit complicated, but you need to remember that, and that complication makes kind of accounting a bit of protected profession, because it takes some time to figure it out how it works, and it provides a good job security. So let's see. Let's go back to our situation. Now we need to figure out how to treat such situation under the accrual method of accounting. Let's go to that memo. Let's scroll down to the accrual method. Income. Generally, you include an amount in gross income for the tax year in which all events that fix your right to receive the income have occurred. Under that rule, you report amount in gross income on the earliest of the following dates: when you received payment, when the income amount is due to you, when you earn the income, when title passes. So the earliest of the following. Now let's see what happened in our situation. So we basically earned the revenue. Let's say revenue earned. And here we say we recognize the taxable when we earned the revenue. So what will be the answer to the question? Which method will defer income? What will be the answer to the question, which method will accelerate income? And under which method we have more manipulation with income? So obviously, cash method. Cash method will defer income. Accelerate income. Accrual. Let me do a bit of clarification here. Tax. We are talking about tax manipulation here. So we have no options to manipulate our taxes if we are accrual basis taxpayer. We can only recognize revenue when we earn it, unless we get a prepayment. If we get a prepayment, then we have an option to recognize income when we get prepayment, or recognize income based on accrual basis. So more manipulation is available with the cash method. Now that's manipulation will be a bit limited, because we have only field to manipulate as far as we have any power over our customers. If we can manipulate the timing when they pay us, we can manipulate our income. And now we have the question, who can benefit? A taxpayer with long customer payment cycle can defer its income under cash basis. So if your customer pay you like with a long delay, you want to be a tax income and you want to defer your tax income as long as you can. In that situation, you will benefit with a cash basis. So I am finishing up for today. Thanks everyone for coming. Hopefully someone will do the homework for tomorrow when we discuss everything in Russian, I will continue working on that memo. By the end of the course, I plan to have all that memo for major types of transaction. Hopefully you will build up your own memo. That's how accountants do stuff. When we study IRS documents, we try to get that information through us, and we try to create a document, an internal document, which will provide us guidance on these subjects when we forgot. So you don't want to go into 56-page document in small font in 3 columns, everything mixed up, everything spread along 56 pages. You kind of want to go in one table and be able to find your transaction which you have question how to treat, or which you want to kind of optimize from the tax standpoint, and you want to find the regulation. And if you still have questions, you can go find that regulation in the document and read more details about that. So thank you for coming and have a great day. Bye bye.